Picture this. It's a random Tuesday. You finally have exactly $100 sitting in your account that you don't need for rent, food, or your phone bill, and you think, okay, this is it, my investing era. So you pull out your phone, open up social media, ready to build a real investing system, but instead,
You immediately get hit with headlines screaming, turn $100 into 10 grand in 30 days, or buy this one crypto before it absolutely explodes. And you're just sitting there thinking, look, I just want to do this the smart way without literally lighting my money on fire. Because here is the honest truth. $100 is absolutely enough to start. But it's also the exact amount people waste chasing these crazy shortcuts. And when beginners lose their first $100 on hype like this, they don't just lose the cash, they lose the confidence to ever keep going. By the way, I'm Jock, and if you're someone who doesn't know how to invest your first $100, make sure to hit the subscribe button and give this explainer a thumbs up. Section 1. The First $100 Trap. Okay, let's dive right into this because most people are dead wrong about this first step. They think their first $100 is about finding the perfect, magical investment. But honestly, your first $100 isn't about picking winners at all. It's about conquering your own fear, excitement, ego, and impatience. You see, the biggest difference between people who build long-term wealth and people who don't, well, it isn't intelligence, it's behavior. Check out this comparison from Dalbar's 2024 research. The average equity investor saw a return of about 16.5%, but the S&P 500, the broader market, returned over 25%. I mean, that is a massive gap. And it's not because everyday investors are stupid, not at all. It happens entirely because people buy and sell at the exact wrong times. They panic when the market drops, and they get super greedy when things peak. So, we're going to lay out a simple plan to help you dodge these psychological traps. Moving on to Section 2, Step 0, the emergency check. Before you even think about buying a stock, there is one absolutely crucial question you have to ask yourself. And that question is, if an unexpected expense happens, will you need this $100 back immediately? Because if the answer is yes, then throwing it in the stock market might actually be a terrible idea. Now, what's really interesting about this finding from the Federal Reserve is just how common this is. When faced with a $400 emergency expense, only about 63% of adults could cover it with cash. That means over a third of people simply cannot. But here's the stat that is just a total gut punch. 18% of adults told the Fed that the largest emergency expense they can handle was under $100. Think about that for a second. If you're in that group and you invest your only $100, what happens when a flat tire or a medical bill pops up? You're forced to panic sell your investment at the absolute worst possible moment. In that scenario, investing didn't build your wealth, it actively hurt you. Section 3, the 3-bucket framework. So how do we actually build a system to fix this? We use a simple framework to protect you from those exact beginner mistakes. Think of your first $100 as needing to flow into one of 3 possible paths. Number 1 is safety, number 2 is high-interest debt, and number 3 is actual investing. Let's break down exactly where your money belongs right now. Bucket 1 is safety. If you literally have zero emergency savings, the absolute smartest first move is putting that $100 straight into a boring savings account. And yeah, I hear you, you're saying, Jack, that's not investing, but actually scratch that, it absolutely is. It's an investment in your ability to stay invested later. When financial stress hits, your brain doesn't care about long-term returns. It just screams, I need cash right now. This is loss aversion in action, where we feel losses way more intensely than gains. Our inner lizard brain completely takes the wheel. Having even a tiny emergency buffer protects you from this psychological reaction and stops you from panic selling. Now, if your safety bucket is good to go, we look at bucket 2, high interest debt. I like to call this the guaranteed return. Let's say you're carrying a credit card balance that charges 25% interest. Taking your $100 and paying that off is mathematically identical to earning a guaranteed 25% return on your money. No way is the stock market ever going to guarantee you that kind of return. So you might need to put your money here first. Not because the stock market is bad, but because you can't fill a bucket that currently has a giant hole in the bottom. Okay, let's assume you've got a buffer. You have zero urgent high-interest debt, and you can truly let this money sit. Welcome to bucket 3, actual investing. Look, I'm just going to give it to you straight. Your first $100 should not go into individual stocks, meme coins, or penny stocks. Could you get lucky? Sure, for sure. But that's not investing. It's just buying a lottery ticket. The smartest play is to buy the entire market at a low cost. Even professional active managers usually underperform broad market indexes over long periods. If the Wall Street pros can't reliably beat the market, a beginner riding on a hot tip from social media probably won't either.
Section 4. How to actually invest. Let's transition right out of the theory and get into the exact actionable steps you need to take.
Here is exactly what doing this looks like. Step 1, choose your account. Find the lowest fee, most tax-efficient account you can, like a workplace retirement plan or a standard brokerage account. Step 2, choose one broad index fund. Honestly, don't overthink this. A total market index fund, an S&P 500 fund, or a target date fund works perfectly. Step 3, invest the $100. Most brokerages let you buy fractional shares now, so even if a single share is expensive, you can still get in. You buy it, and boom, you're an investor. But step 4 is the real secret sauce here. Automate the next contribution. Let's look at the numbers because they are honestly mind-blowing. If you invest your $100 once, never add another dime, and get a 7% return over 30 years, it turns into about $760, which is, fine, but it's not exactly life-changing. But watch what happens when you build the habit. If you automate just $25 a week for 30 years at that same rate, you end up with roughly $120,000. The initial $100 barely even matters compared to the habit itself. You didn't reach $120K by being a stock-picking genius. You got there because you were consistent. Automation beats motivation every single time. But wait, there is a silent killer here that you absolutely have to watch out for, and that's fees. Fees are incredibly boring, which is exactly why they're so dangerous. An actively managed fund might charge you 1% a year, while a broad index fund might charge 0.05%. And I know, a 1% fee sounds literally invisible right now, but over decades, it spreads like wildfire. That tiny fraction compounds, and a low-fee fund can actually end up over 30% larger than a high-fee fund. Those tiny percentages quietly eat your wealth, which is why low-cost index funds are the ultimate starting point. So if it's this simple, buy a low-cost fund and set it on autopilot, why doesn't everyone just do it? Well, because our brains are completely wired to mess this up. Your brain craves excitement. And let's be real, index funds are about as thrilling as watching paint dry, while day trading feels like a trip to Vegas. Plus, your brain hates being wrong, which triggers that panic selling the second your portfolio drops in value. And finally, your brain really wants to feel in control. Picking stocks feels like you're actively steering the ship, but ironically, in investing, doing less is almost always the winning strategy. You have to fight your own psychology to keep it boring. Which brings us to the end of our explainer today, and I want to leave you with a real challenge. What are you going to do in the next 24 hours? Most people never invest their first $100 because they're sitting around waiting for the perfect time. But people who actually build wealth don't rely on perfect timing. They build better systems. So, will you put that $100 into an emergency buffer? Will you invest it into a broad index fund? Or will you log in right now and automate your next contribution, even if it's just $10? Take one concrete step today to build that system. Because one day, you're going to look up and realize something truly amazing. The ultimate change wasn't the money. It was you.